Hello traders, welcome to FreeFX episode 146. My last episode was an interview with Adrian Alberts from Blackheart Red Spade. Today we're back to trading analysis. We're going to look at the SPX. Now it's been a difficult few weeks for me since the sort of end of October. So I've sort of been looking at trying to recoup some of the losses from there. And how I've done this is I've checked the situation with the SPX, trying to look wider because I think there's a possibility here to make some moves to the downside. So essentially my downtrend scenario analysis hasn't really changed. Unfortunately the timing of it has been the problem. Lots of kind of false signals and stops and starts. So I've closed some of my trades, tried to kind of get in the right place. I'm still short on a small position from the CPI day, which was this massive candle that we'll remember, the 5.5% increase to the upside, and that's really where I'm at with that particular trade. I've entered some shorts around here, but sort of had to close them because they weren't really going anywhere. So I'm just waiting at the moment. We're just above the basically, we're just above the 3,900 level, 3,946 at the moment. So actually halfway between that and 4,000. The red number there refers to this red line, and that's the 4,000 level, obviously. I put that there because it's such a strong level. I mean, I'll take it off because it really just refers to this particular area here. Yes, we had it before, back in July. And the 3,900 is a very important level, which is down here. It was resistance back in October there, and then we saw that the 3,900 level interacting there in June and July, and then it became support back here in September. I've showed you all that before. I had to take it off because, you know, charts become very overcrowded quickly, so unfortunately then one forgets because one doesn't see those marks anymore. But anyway, we can see where we are with the 4,000. It's kind of been a few days of interacting with it. So what is the trading plan here? Well, I've been using Bollinger Bands for quite some time, and I've sort of based my trades on them. But recently, price action has been kind of messy and didn't really give me a confirmation of where kind of the short side was going. So I decided to set up what I've done before, which is parallel channels. I've used them a lot in Forex. Not to say that that is the way to win trades, but certainly from an analysis point of view, sometimes the wider trend is easier to see when you are looking at the whole picture. Just like the Euro USD from the peak of the 2008 financial crisis to the present day, it's one big parallel channel. Of course, that doesn't help intraday or intra-week trading, but certainly if you want a wider picture, if you're lost in the woods, always good to take a step back and see sort of where we're at. And sometimes, you know, if only one would do that, one would see very clearly. For example, when we were here before the CPI rally, maybe having the patience to come to these levels and then start shorting all the way down. Of course, when we saw this back in August at the peak of that so-called bear market rally, it did come down, but we had these sort of big upswings like here in September, where the upswing there, and then we had the 13th of September big CPI drop there. The exact opposite, one might say, than the big pickup here on the 10th of November CPI. But you know, that's why I based my trade on that, because I thought the CPI numbers would be interpreted as still, you know, high inflation, not necessarily a good number. So that's kind of where we're at now. Unfortunately, as you can see, I have the pleasure to tell you the big downtrend is still in place, and we've had confirmation of that recently with this turn. If you look at this turn, obviously we've got quite a few days into the turn, and that means that we've got a period to assess that's kind of comparable to other market data. So if we look back, we've got 6 trading days, including today. and the 6 trading days essentially take us to this turn here. This turn that I'm just showing you here was made of 1, 2, 3, 4, 5 trading days essentially, and then the turn happened, you know, gradually, but you could still get your head ripped off, you know, back here in September. But that is basically what we're looking at. And if we go further back, we have this point here. So we had 1, 2, 3, 4, 5, 6 days essentially. So we're looking roughly at a week. That's not very precise, I know, but it's kind of where we're at now. So any time between, I don't want to make predictions, but it looks like any time between today, this is still Thursday, so let's say tomorrow, because it's nearly midnight. So tomorrow and next week, we could see hopefully some movement away from this congestion, because it's been quite difficult to make any sort of decision when you're sticking to these points. There is the options expiration scenario, where by the end of this week, all options, including VIX options, will have expired, and so that would be something that might move things. I mentioned this in the interview with Adrian Alberts just the other day, how much talk there is of options doing this, options doing that to move the S&P 500. Of course, the S&P 500 is based on fundamentals as much as anything else, but also based on options and also based on technicals. So what we see on the chart, as you can very easily you know, see here, is of course when you have a lot of past history, it's you know, this trend is becoming mature. So in a way, its shape reinforces a continuation, but there needs to be obviously a fundamental backdrop that encourages that, and I think there is, and others you know, agree to say that it's not for me to dictate what price should do, but you know, people with better knowledge than me of fundamentals and macro themes have, you know, really raised all the concerns that there isn't really a fundamental backdrop that justifies a euphoria in capital markets, such as this particular asset class, which is indices, US indices in particular. So the downtrend, let's call it downtrend, although, you know, it's not down in the sense of down. If you're trading it profitably, it doesn't have to be a bad thing, bear market, with all the connotations that brings. It is a trading opportunity. So if we treat it as an opportunity, there is plenty of scope to the downside. Down to these levels, as I said, we're looking at the 3,400 level. So that would give us quite a few points to play with carefully, but also with you know, hopefully some conviction that one can amplify some gains when the time comes. Looking more widely on the weekly, you can see the points I've highlighted before, the 3 CCI peaks, and we are actually below this peak here. This peak 56 roughly. Currently we are at I think this is probably not very correct. Let me see that again. 26, and this was 56, yes. So we're about 26, and previously we were at 56 back in on 15th of August, and the one here on the 20th of March was 14. So we're somewhere between that peak in March and the one in August. But you know, both of those peaks then reversed, and we had a significant leg to the opposite direction. So I think this is where we need to watch. It won't happen in a straight line, but I should add that the first peak back in April resulted in not just 1 week, but 7 consecutive weeks to the downside. Of course, there was a massive wick up there on the 2nd of May. So it's not to say that it's going to be a straight journey down, but you know, with some risk tolerance and just keeping an eye on margin, I hope to capitalize on a significant move down. In 2008 we had a very strong move down, and just to give you a sense, because I keep referring to this and a lot of others have referred to this, it's not just me, we were looking at the final stages of that drop being very significant indeed. So if I just take your attention back to the hazy days of the great financial crisis as was known, and this is also a financial crisis in the making this year's. So I just wanted to show you the final leg there of 2008. We had September, big drop, October, and the final leg was here in February. Okay, so what happened in December, November, again, big drops there. Just to kind of give you a sense, I wonder if I should put it as a logarithmic chart. Let's see, put it to logarithmic. Okay, now you get a bit more sense of how big these were. Let's look at the November. So from the high to from the high there. Okay, from the high to the low, we're looking at roughly 20%. 20% move. That was sort of back here in November, December. Okay, so that finished or sort of bottomed there in November. Then we had a few weeks, and then it was February before that was pushed low. So the market, as in the S&P 500 in the SPX form, bottomed on the 2nd of March, not on the 13th of October 2008. So indeed it dropped a further, if you just measure that, I had to go further out to read that, it bottomed a further 23% roughly before it went down another 23%. So that's quite incredible. You know, interestingly though, if you look at the divergence there on the weekly, the CCI started diverging. This was kind of going down and this was going up. So there was a signal there. So I'm not just a negative divergence kind of person. I also look at the opposite, obviously. But so far, for me, it's been a tale of looking at negative divergences for the next leg down. Because in a down trend, you want to obviously look at entries to the downside and looking at divergence when there are so-called false rallies. So if I go back to the daily at the moment, now I've highlighted the divergence that I really wanted to focus on. The divergence of the daily chart was here, 25th of October down to the 31st of October. So basically the last week in October, and we were having price pushing up. Then it finally sort of came down, bounced off the neutral line, and then it shot up obviously, and then we came to the we came to the 2000, I can't really say that, the 200 level at the 4000, that's what I meant, and it sort of pulled back. Price has not been pulling back so hard, but this has. So there's the sort of divergence, but this time we have a divergence between a flat price and the CCI pulling down. Usually it's sort of opposite directions, but in this case we have flat versus a downslope. And that's also significant because it tells you that look how much it's dropped versus how little this has moved. So something is amiss with this sort of reticence to move, and I think it's probably important to give it some credit in terms of predicting a potential move. The other thing that I was going to go down on in terms of time frames is the 4-hour, because this obviously gives us quite a bit of scope to do analysis. And just to kind of show you, I've done lots of these kind of divergences, like that one here back in October. I've just taken them off the chart because it was taking too long to read everything with everything on top. So divergences, we've had this one here obviously in October, and I showed you some before, like in September when we had the CPI, as I call it, CPI Tuesday there in September. It was this one leading up to it, from the 6th to the 13th. We had the big rise there. That big rise took us above the 4,000 level to almost, yeah, to 4,100 and plus, and then we had a big drop there on the CPI. So that divergence, that negative divergence, actually came to play, came to pass exactly as per intended. This one, obviously divergence, a little drop down but not below, so it kept going up, and we had a sort of divergence between here and here, and then that moved down. So lots of these examples of divergences, always to the downside. This one is not so much. This one, as I mentioned before on Twitter, etc., we've had a divergence from that peak of that push down to here. The market kept pushing up, and then finally we started coming down below the 4,000 level, and that's been a big push. We bounced back, but I think this has scope to continue lower. Obviously, you know, the fact that we've had so many above the zero line almost makes me think that we are in a so-called not zero line, sorry, the negative 200. We've had a couple of these kind of extremes, sort of, it's kind of generated a bounce all of its own, and here as well. What I was meant to say was that we've had quite a few backwards and forwards, but this is where the 4 hour is getting a little bit messy. So I will look at the daily really for clarity, because it's been a bit of a wild ride. So the daily, I think, is much more clear now. The daily is above the zero because of these recent pushes, but as we saw at the end of the so-called bear market rally, we pushed back below zero and we were underneath it from the 23rd, in fact the 22nd of August until the 17th of October. So almost 2 months, and we are in this part of the cycle, which is taking us from the 17th of October to today, which is the 17th of November, so 1 month. So the upper cycle above the zero line has taken less time, although we have more to go. There's a few more days of this. The last time we were about this level was on the 2nd of November, and it took us until the 3rd of November, so that happened in a day. Very quick drop there with the Federal Reserve Bank rate announcement, and of course we have a rate decision in December, but that's a few days away, so we don't want to wait that long, hopefully, or don't want to have to wait that long, because there's been a lot of waiting for shorting this, obviously because of all this mess now we have to endure. So why do we want to see the break below zero? Because that will give us confirmation that we're going to continue. And obviously these swings are quite dangerous, but you know, when we get to the minus 200, we know we're coming to the end of these moves, and when we get to negative 200, we can kind of again watch and reconsider. We might get an extra few days, like an extra 3 days or 4. Here it was 1, 2, 3, about 3 or 4 days. So we could say on average that 3 or 4 days below before a turn is appropriate. I have to go and check this and put it in my rule book. But it's you know, it's certainly, I would sort of go back and compare when we get to that point. So nothing to be scared of. Now I think that's the end of the video. I don't have anything else to add at the moment. Obviously looking at one more thing just to really finish there. The 1 hour chart, we saw that big CPI day there. If we look at, for example, this drop that we've had this week on the Thursday, there was no major economic data. It wasn't the Russian missiles. Well, actually, maybe it was, but it wasn't really that. I think it was more maybe options expiration or something. We came down to this low here, which was 3907. So right smack down on the 3900 level essentially, and then bounced back. The 1 hour sort of fell down to very, very low levels. We're looking at minus 275 on the CCI, which is very low. We not had such big pushes until since the 2nd of November. That was the Fed day. Rate decision, highly anticipated, but very, very strong rhetoric and everything. That sort of pushed us down to these levels. Actually, we're already down there, but this pushes even to 307. That's quite extreme. It's the 1 hour, obviously, it's more responsive, but so we push down to, yeah, same 308 actually. So big bounce back from there, and the 1 hour was kind of very interesting to watch at that point. I'm going to finish right there. So without further ado, thank you very much for watching. Also keep an eye on my channel because I have more videos and things coming up, kind of more projects and things that might interest you as well. So, but good luck trading. Is going to be an interesting week as we come through the options expiry tomorrow and see what will become of the S&P 500. Take care. See you in my next videos. Good night.